Okay, let us start the CFA Level 1 Prerequisite reading, organizing, visualizing, and describing data. So this chapter is mainly about understanding how data should be organized, presented, and interpreted in investment management. Okay, because see, in today's investment world, we actually work with massive amounts of information, right? The analysts, the investors, they work with massive amounts of information. But if you just have raw data, that alone will not help you make decisions. The real value of that data will come from how well we can structure that data, how well we can summarize that data, and how well we can visualize that data. Okay, so we'll try to have a decent understanding of the tools that analysts use every day. We'll see a lot of ideas like frequency tables, charts, uh, other aspects of descriptive statistics and how they help to transform complex data sets into meaningful insights. So let's start. Okay, the data revolution in finance. See, the investment industry is undergoing a massive transformation, a massive growth, okay, driven by the explosion of data. We have now more information available than ever before. Okay, it ranges from market data and economic indicators to alternative data sets, like even satellite images, okay, consumer behavior signals, okay. But with this explosion comes actually a challenge. Today's analysts, they spend approximately 80% of their time not analyzing data, but finding, organizing, cleaning, and analyzing data. Actually, 80% of their time is spent in finding, organizing, and cleaning data, and the remaining time is spent in analyzing the data. Okay, so this means that the real bottleneck is not the analysis. Okay, it is data preparation so that it can be used. I think this should have been corrected. 80% of the time should be used in finding, organizing, cleaning, managing it, and then I think the remaining 20% time is spent in analyzing it. That should have been written over here, anyways. Now, this is why data literacy has become one of the most essential skills you can say in investment management. Okay, the ability to structure data, visualize data, interpret data effectively, it directly impacts the quality of investment decisions. So let us start by understanding the data types, what kind of data we are dealing with, because the type of data will decide which tools and which charts we can use. So first we have numerical data. Okay, these are, you can say, these are quantitative values we can actually measure or count. So for example, stock prices, returns, number of trades, okay, and discrete data like number of trades, payment frequencies. And in finance, almost all performance analysis is based on numerical data because we are always working with numbers, most of the time. In fact, not always, most of the time we are working with numbers. Then we have categorical data. Okay, these describe characteristics, okay, not numbers, like sectors, regions, country, rating, fund rankings, investment styles. Okay, so categorical data, it actually helps us group, it helps us filter and also compare. For example, which sector performed the best or which rating category is riskier. Okay, so this is about numerical and categorical data. Now, let's break numerical data into two very important types: continuous data and discrete data. Okay, so let's start with continuous data. Now, continuous data can take any value in a range. Okay, stock prices, returns, interest rates. These they actually don't jump from fixed numbers. They can also take decimals and they can move smoothly. We have discussed continuous random variables also. In fact, we will discuss continuous random variables later on. So you'll see the idea is the same. Also, portfolio values. Okay. Um, then cash dividends per share. So all these are examples, and most risk calculations like standard deviations, variance, correlations. Most of them they use continuous data. Then you have discrete data. Okay. Now in discrete data, it is limited to finite countable values. Countable. Okay, it can be counted. So for example, the number of coupon payments, trading volume in shares, compounding frequency, number of defaults, all these can be counted. These are whole numbers. You cannot have, say, when you talk about number of coupon payments, you cannot have 3.7 coupon payments. You'll have either 1, 2, 3, or 4 coupon payments, right? So in finance, continuous data helps us measure performance and risk, whereas discrete data helps us count events. Okay, both types are quite essential. Okay, which one we are working on, that will determine the right tool, as we said earlier. Okay, now that we have discussed numerical data, let us just shift to the second category, categorical data. Categorical data, it helps us describe what something is, as I said, rather than how much or how many. Okay, so what are the types? How can we classify them? First, we have nominal data. Now, these are categories without any natural order, without any logical order. They are just labels, you can say. So, in finance, this is extremely common. Okay, you can, if we take example, you can have GICS sectors, energy, materials, industrials. None of them is higher or lower, right? You can have geographic classifications like APAC, EMEA, okay, ASEAN, uh, ASEAN. Okay, then let's say even if I say North America, that's also a geographical classification. Okay, then hedge fund strategy types also. Okay, like you have long short equity hedge fund, you have global macro hedge fund. Okay, you have event driven hedge fund. So these are just classifications. So nominal data is used whenever we want to group or filter investments, but not rank them. Okay, that is nominal data. Then you have ordinal data. So here categories do have an order, or you can say, or a hierarchy with meaningful ranking, you can say sometimes. So for example, credit ratings from AAA to D, they have a natural ranking. AAA is the highest ranking, then you have AA, and gradually you go all the way down to D, which stands for default. Okay, for example, Morningstar's ratings. Okay, again, 1 star to 5 star rating is given. Then fund performance deciles. Okay, this is used in manager evaluation. Which manager was in the top 10%, then second 10%, then third 10%, okay, based on the performance. So this is ordinal data. So in summary, nominal data helps you to classify and ordinal data helps you to rank. Okay, both are important for organizing real world financial information. Okay, let us discuss an example related to identification of data. So portfolio manager makes several trades each day, and the number of trades changes based on market conditions and their strategy. Okay, so the number of trades executed is discrete numerical data. Another example, the closing price of a stock is set at the end of the trading session and can take many possible decimal values. Okay, so this is an example of continuous numerical data. Both of them are numerical. One is discrete and the other is continuous. Next, many investment advisory firms often classify clients into low risk, moderate risk, or high risk tolerance categories. Okay, so what kind of data is this? This is actually categorical and this is ordinal data, because the order is important, rank is important over here. Low risk tolerance, moderate risk tolerance, and high risk tolerance. Then clients of financial institutions can hold various account types such as savings, checking, brokerage, and retirement accounts. Now here you just have Classification categories where order does not matter. So under categorical also, this will fall under the subcategory of nominal data. Okay. Now let us look at data collection formats. Okay. Let's start with cross-sectional data. Now cross-sectional data compare many observational units, you can call them, like companies or countries at one point in time. Okay. The variable is the same across all units. Okay. Like an inflation rate, earnings per share, or a PE ratio. Okay, this is an example which is given. January inflation rates for all euro area countries. It is a classic cross-sectional example because it is being measured at a single point in time. So cross-sectional data lets us compare entities side by side at a single point in time. Then you have time series data. Time series data, it follows one observational entity through time. Okay, like one company, one index, or one market. Okay, the variable is actually tracked across periods over time. Okay, usually at regular intervals. It can be irregular intervals also, but usually at regular intervals. Okay, so for example, daily closing prices of a stock over a month is a typical time series data set. So time series data, they highlight trends, patterns, and temporal dependencies, time related dependencies. Okay. Then you have panel data. Now, panel data, they actually blend the features, they combine the features of cross sectional as well as time series data sets. Okay. So we track several observational entities. Okay. And each entity has multiple observations over time. Okay. For example, when you talk about EPS, uh, say for several companies, quarterly EPS for several companies. So across time also you are tracking it, and across different observational units also you're tracking it. Okay, you can represent it using a two-dimensional array. Rows will be time, columns will be companies. Now panel data are quite powerful because they offer variation both across time as well as entities simultaneously. Okay, now let us look at structured versus unstructured data. Now structured data, it they actually follow a very clearly defined format. Okay, highly organized, predefined format. We see repeating patterns, consistent fields, proper tabular kind of arrangements that computers can read directly. Okay, now in finance, this includes market data like prices and volumes. Okay, fundamental data from financial statements, and analytical outputs like forecasts or projected cash flows. Okay, different metrics. Now, these data sets, they fit naturally into columns and rows. So the analysis and the querying and analyzing are actually quite easy and straightforward. Okay. Unstructured data are very different. They do not follow any conventional layout, any conventional organization, and they often appear as free form information. You know, free form information. You can have text, audio, images, and other formats, that lack a predefined structure. So if you take examples, this will include financial news articles. Okay. Uh, it can also include company filings. Okay. Social media activity, social media posts, and even audio or video from earnings calls, let's say. Okay. Now, much of today's alternative data originates here, coming from sources like search behavior, credit card transactions, satellite imagery, or mobility sensors. Now, this requires transformation for analysis. Unstructured data, unlike structured data, which is easy to query and analyze, it requires transformation for analysis. Okay, now let us come to alternative data sources. So till now we have looked at traditional data used in finance, prices, returns, financial statements, but the industry has evolved. Today, a huge amount of investment, the insight of the investments, it comes from alternative data, non-traditional, mostly unstructured data sources that give analysts an information edge. Okay. Now, in this, if we talk about categories, the first category will be individual generated data. So, this is data created directly by people. Social media posts, search trends, uh, product reviews, okay, consumer reviews. Now, analysts use this kind of data to track consumer sentiment. Okay, they also track brand perception among the consumers. And of course, early shifts in demand can also be tracked. Okay, so if you want to take an example, a spike in negative reviews, let's say, for a smartphone brand, okay, on websites or important portals like Amazon, Flipkart, etc. It may predict falling sales before any earning announcements comes. Okay, then you have business process data. This is the second category. So these come from corporate systems, okay, like credit card transactions, regulatory filings, invoicing, shipping records, also supply chain data. So this type of data helps reveal real-time economic activity. Okay, so if you take an example, you can have aggregated credit card spending, which can show that consumer demand has weakened. Okay, if aggregate credit card spending has decreased, then consumer demand has weakened. It has reduced much before GDP numbers are released. Okay. Next, you can have sensor generated data. So this includes satellite imagery, geolocation data from mobile phones, and even foot traffic patterns. Okay. So there are hedge funds which analyze parking lot satellite images to predict retail revenues. More cars usually translate to higher quarterly sales. Okay. So together, these alternative source data categories, they allow investors to capture insights that traditional data simply cannot reveal. And this can give them a competitive advantage, you can say. Okay. Now let's see organizing data for analysis. See, raw data in their initial form, they are rarely usable. They may be incomplete, they may be inconsistent, may have poor formatting, okay, that models cannot interpret. So before we analyze anything, we have to first convert this raw information into a structured format. Okay, then two primary organizational structures enable effective data processing. The first structure is a one-dimensional array. It is a simple linear sequence of values which makes it quite ideal for a single variable, especially when the observations follow a time series pattern. Okay, then you have two-dimensional array. Okay, so this is the second structure. This is also called as the data table. Okay, this is the standard format for analyzing multiple variables simultaneously. Okay, so in this structure, each column represents a variable such as say price, volume, or earnings, and each row will represent an observation at a specific time. Okay, so mostly it is relevant to panel data. But this alignment, it creates a clear, consistent data set that analysts and models can process quite efficiently. So by organizing the raw data into one-dimensional and two-dimensional arrays, we can transform unstructured or scattered information into structured inputs, which can support reliable quantitative analysis. Let us start with this structure, data table structure. So whenever we work with financial or economic data sets, The very first thing we should get right is the structure of the data table, because if the structure is incorrect, every calculation, returns, risk metrics, all of the calculations will be wrong. That is why data cleaning always starts with a proper layout. Okay, so in a standard data table, you have columns which represent variables such as I said earlier in the previous slide, also prices, volumes, etc. And each row represents uh, a time period, okay, single time period, a day, a month, quarter, any other interval. Okay, if even one of the variables is not aligned properly, okay, say one series starts earlier, let's say, the entire analysis can get completely distorted. Okay, now what is the key principle over here? The key principle is that all the variables must be perfectly aligned to the same time scale. Okay, because if suppose you have daily stock prices, if you are matching it with monthly interest rates, that is not correct, right? If suppose you have missing days, if they are not handled, the analysis will become unreliable. Okay, so before doing any kind of statistical calculations, mean, variance, correlation, everything, you have to ensure that everything is synchronized properly. Okay, now let us come to frequency distribution. Okay, this frequency distribution is the simplest way to understand how data are spread. Okay, it is a tabular display which shows how often each value or range of values occurs in a data set. Okay, this table, the frequency distribution table, it becomes the foundation for understanding data patterns before moving into charts or visualizations. Okay, so let's start with absolute frequency. Now, absolute frequency is the raw data count, you can say. It shows the number of observations that fall into each category or each bin. Okay, it helps us see which groups dominate and where different kinds of concentrations may lie. Then you have relative frequency. Now, relative frequency, it converts those counts. It converts those counts into proportions or percentages of the total. Okay, this is also quite useful because it allows us to compare data sets of different sizes and understand the composition more clearly. Okay, so frequency distributions, they transform raw observations into a structured summary. Absolute frequency show the counts, relative frequency show the proportions. Okay, and together you can say they provide the first clear view of the shape, the structure of the data set. Now let us try and understand how to build a frequency distribution. Okay, so the first step is simple. You sort your data. We arrange all the observations sorry, either in ascending order or sometimes in descending order also, but generally in ascending order, because every remaining step will depend on a properly ordered data set. Okay, then you calculate the range. So that's just the maximum value minus the minimum value, which gives you the total spread of the data set. Then you determine the bins. Okay, so once we know the spread, we decide how many bins or intervals we want. Now over here in the curriculum, they actually have mentioned that the number of bins will be equal to k, and yes, we'll start with k, but sometimes you'll find that the number of bins actually becomes k plus 1 also, especially when we are rounding down. Okay, but if we are using uh, uh, k and we are using the interval width after deciding k without rounding down, and you'll be able to appreciate this point later on. You may not be able to understand right now what I'm saying regarding rounding down and why it should become k plus 1. I actually have uh, incorporated an example later on to just give this idea. So in the curriculum they say that number of intervals is k, but it is not necessarily true. It can be if you choose the value of k, yes, most likely the number of intervals will be k, But if you do any kind of rounding down or any adjustments, then the number of intervals will increase from k to k plus 1 mostly. Okay. And then you calculate the bin width. So how do you calculate the bin width? Range divided by the number of bins. So this is calculated as the range divided by the number of bins. You can say k. Okay. Okay. So number of intervals, sometimes it becomes k plus 1. Okay. And finally, we count and tabulate. Finally, we count and tabulate. We count how many observations fall into each bin and construct the frequency table. And this table will become the basis for histograms and other kinds of descriptive statistics. Okay. Okay, let us understand cumulative frequency distributions. So cumulative distributions, they show the running total of frequencies, which allows us to determine how many or what percentage of observations fall below a particular value. Okay. The first piece is cumulative absolute frequency. That is, this is simply the running total of the counts as we move through the data. Then next you have cumulative relative frequency. So same idea, but now we accumulate the percentages or proportions that we discussed earlier instead of the raw counts. Okay. Because when you have relative frequency, you can also calculate the cumulative relative frequency. And these cumulative values are extremely useful when we need to compute percentiles. Now, choosing the effective number of bins. Let's start by understanding how to, what kind of factors you should consider when you are choosing the number of bins. So let's start with the first point. If we create too many bins, the histogram becomes unnecessarily detailed. You'll see a lot of empty intervals, which makes the distribution look noisy rather than informative. On the other hand, if you have too few bins, it will hide important variation in the data. Patterns that matter for investment decisions, like clusters or tail behavior, they may not completely appear. They may not completely disappear. Sorry. Actually, the patterns, if you talk about yes, actually, these patterns may disappear. Sorry, they might completely go away if you have too few bins, because it is very important to capture these patterns. They matter a lot for investment decisions. Clustering, tail behavior, all these things matter a lot. So if you have too few bins, these kind of variations might be lost. They might disappear. Now, good practice is to begin with a small bin width and adjust. You can think of this as tuning the resolution of your picture until it becomes clear but not very pixelated. Okay. Also, make sure that you choose K or the number of bins. Okay. So again, I'll be very careful over here. I'll I'll write choose the number of bins, because K may or may not be the number of bins. Okay. K may or may not be the number of bins. So choose K. So bins are meaningful and interpretable, or you can say choose number of bins so that they are meaningful and interpretable. Okay. So the goal is insight, interpretability, not just aesthetics. And finally, we'll try to prefer whole number bin bits like 1%, 2%, etc. 1% increments just for clarity. Okay. Especially when you are dealing with returns. This will make the distribution easy for analysts and clients to read. Now, this is the case where your number of bins will become greater than k if you are trying to round down just to make sure that you want whole number bin. Okay. If you don't want whole number bin width, if you just directly want the interval width to be equal to range by k, then there is no problem. The total number of intervals will still be k. But if this is the case, then the situation will change a little. Now let's discuss an example of constructing a frequency distribution. So commodities analyst collected annual returns in percentage for 5 major commodities to assess how volatile the commodity market has been. Using the data, we have to construct a frequency table to summarize the distribution of returns. Okay. So using the returns which will be shown, we'll construct a frequency distribution and summarize key insights. Now, what are the annual prices which are given? Annual price returns, sorry, which are given. So these are the annual price returns which are given. For gold, the annual return is 4.8%, crude oil 12.5%, wheat 3.1%, coffee 11.3%, aluminium 7.5%. Now, what was the first step in constructing a frequency distribution? First, what we do is sort the data. So we start with the lowest one. You see the lowest one is 3.1%. So we start with 3.1%, then 4.8, 7.5, 11.3, 12.5. All of them are in percentages. What is the range? Range is max minus min, which is equal to 12.5% minus 3.1%, which is 9.4%. Now let's use k is equal to 3 because it's a very small data set. Let's use k is equal to 3. And now we think that k is the number of bins here. Okay, and I told you earlier, this may or may not be correct. So let's see the interesting adjustment also. So first we'll find out the bin width. Bin width, if you remember, I told it was range divided by k, right? Just now I told range divided by k. Okay, that is your, just a minute. Where am I written? Bin width, range, yeah, over here. Range divided by k, okay? Now, this is my bin width, range divided by k, which gives me 3.13%. And now I round this down to 3%. Now this rounding down itself will ensure that my number of bins will actually now increase. Okay, because see, if you divide 9.4, the range is 9.4. So if I divide 9.4 by 3, I get 3.13%. Okay, so the bin width is actually 3.13%. So converse also I can do. I can, if I want to find out the number of bins, I will divide 9.4 by 3.13, which will give me 3. So that will be the number of bins. But now I am spreading each bin width to 3%. So basically to find out the number of bins, now I'll have to divide 9.4 by 3%. Actually, it will not even be 9.4 also because we'll extend the range also. But you see what has happened? The denominator has actually reduced now. Okay, to find out the number of bins. So that's why the number of bins will become actually 4. And you will see it after this slide. Okay. And then you will be able to appreciate this point even better. So we create the bins. So since we have rounded down to 3%, okay, because we discussed that we would prefer whole numbers, right? Increments of whole numbers also, and the intervals also, the endpoints also being the whole numbers. That is what we prefer actually. So once we do that, okay, then you start below the minimum value. Okay, so just below 3.1, which is the nearest whole number, just below it, you have 3%. So this 3% is different. Remember, this is for rounding off the rounding down the bin width, and this 3% is different. This is the value just below 3.1%. Okay, so what are the bins that we have? These are the bins that we have. So 3% to 6% because we have a bin width also of 3%. So from 3% to 6% the first bin, second bin from 6% to 9%, then 9% to 12%, then 12% to 15%. Now you can easily see that even though I used k is equal to 3, We have 4 bins actually, not 3 bins. That is why I said that, in the curriculum it is written that k is a number of bins. It is not necessarily 2, especially if you are rounding down. Okay. So now let us see the full table. So between 3 to 6, between 3% to 6%, how many return numbers we had? So between 3 to 6, we actually had 2 numbers, this one and this one, wheat and gold. So the frequency will be 2. Well, okay. So between 3 to 6, the frequency is 2. Okay. Then between 6 to 9, for each of them, you can check it. We have a frequency of 1. Only one return is between 6% to 9%. One return is between 9 to 12. And one of the returns is between 12% to 15%. Now, how do we find out the relative frequency? How do we find out the relative frequency? So it's quite simple. When we discuss the relative frequency, we told that it's actually the proportion of the total. In percentage, if you want to find out the proportion of the total. So total is 5. 2 plus 1, there are 5 data points. 2 divided by 5 is 0.4, which is nothing but 40%. Okay. And this is the cumulative absolute frequency. So obviously cumulative absolute frequency you can just get by adding all the frequencies just before it, less than or equal to. So just at it or before it. So of course you don't have anything before this bin. So the absolute frequency of the first bin will just translate to the cumulative absolute frequency also over here. But the cumulative absolute frequency corresponding to the second row will actually be 2 plus 1, which is 3. Similarly, for the third row, you will have 2 plus 1, which is 4. Okay. And similarly, if you want to convert cumulative absolute frequency to cumulative relative frequency, again, you divide it by 5 every time. So 2 by 5 is 40%, 3 by 5 is 60%, 4 by 5 is 80%, and 5 over 5 is 100%. Now you see most commodities 40%, so only 2 in this case, they fall in the 3% to 6% range. And the highest return, 12.5%, lies in the last bin, whereas the lowest return is in the first bin. Okay. And each remaining bin has one commodity each, which so shows a moderate spread with no extreme clustering. Okay. Okay, now let us move to contingency tables. Okay, which are extremely useful when we want to analyze the relationships between two categorical variables at the same time. Okay, two or more, you can say. Now, contingency table simply organizes data in a grid format, you can say. One categorical variable is placed across the rows, and the other categorical variable is placed across the column. And each cell inside the table, it actually shows the frequency of observations that fall into that combination of strategies. Okay, it reveals patterns and potential associations between variables. So generally in the CFA curriculum, we will only talk about contingency table in the context of the relationship between two categorical variables. Okay, so not more, but only two categorical variables. So we also call them two-way tables or cross tabulations. Okay, and they play a very important role in identifying, as I said, patterns and potential associations between the variables. Now, they list, as I said, categories of one variable in rows and other variable in columns. Now, for example, if you have sectors on one axis and credit ratings on the other axis, the table helps you to see whether some particular sectors they tend to have stronger or weaker credit profiles. So basically a contingency table, it is just expanding the idea of a simple frequency distribution by kind of allowing us to study the two variables simultaneously. Okay, and of course it will make it uh, an important tool for deeper categorical analysis, you can say. So if you want to understand contingency table, we have to begin with joint frequencies. Now, joint frequencies represent the counts that appear at the intersection of a row category and a column category. So each cell of the contingency table shows how many observations belong to that specific combination of categories. Okay. Joint frequencies are, you can say, the core of the table because they capture how the two variables interact. Next, we look at marginal frequencies. So these are simply the row totals and column totals. They tell us how the observations are distributed individually across each variable, independent of the other, of course. Okay, so in other words, marginal totals, they actually summarize each variable on its own. And finally, we have relative frequencies. These express frequencies as percentages, either of the overall total or row total or the column total. So relative frequencies, they actually allow us to compare distributions more effectively, especially when the groups are different in terms of their size. So together, these three components, joint frequencies, marginal frequencies, and relative frequencies, they actually transform a simple table into a very important tool, which is quite powerful, that reveals a lot of things: structure, relationships, and distribution of the categorical variables. So let's see an example. Okay, a school district tracks how many students are enrolled in different academic programs across three grade levels. The table shows the number of students in each program grade by grade. So this is the table. This is the program, and then you have the grades in the columns. Okay, the program across the rows and grades in the columns. Okay, so the marginal frequency of students, if we want to find out who are enrolled in the sports program, is closest to what number? Okay, if you want to find out this, so see, as I told you, that marginals is just the sum of the joints across a particular row or column. For example, if you want to find out the marginal frequency of, say, arts, you just add all the joint frequencies across this row. So what are these? First, let's understand what are these joint frequencies. So when I talk about, say, sports and grade 6, so in grade 6, how many students are enrolled in this academic program, that is sports? 90 students. Similarly, 15 students are enrolled in language in grade 8. So these are joint frequencies, right? Okay. 40, 55, 20, all these are joint frequencies. To find out marginal frequency, we just add across the rows or the columns depending upon the question or the requirement or the context. Like, for example, this question asks, what is the marginal frequency of students enrolled in the sports program? Okay, so we get three options: 25, 150, or 175. So how we'll do it? We'll just add for the sports program, we'll see what are the joint frequencies in this row where sports is there. So sports is in the third row. Okay. Of course, we are considering that this is the header. So we are not counting it as one row. Anyways, so you have 90 from grade 6, 60 from grade 7, and 25 from grade 8. So it's simply 90 plus 60, which is 150, plus 25, which is 175. So the correct answer will be 175, option C. Okay, now if I ask you about the relative frequency of grade 7 honors program students based on the total student count, what is it closest to? Of course, since we are talking about relative frequency, the answer will be in proportion or percentage, you can say. So we have three options: 14.5%, 11.2%, and 22.5%. Okay. And remember, over here, relative frequency has to be found based on the total student count. See, when we were studying this relative frequency for the first time, I mean, when we introduced it over here, let me just go back to relative frequency. Yeah, we said that they can be calculated as percentage of total or row total or column total. The question clearly states that you have to find it based on the total student count, not the row or column count. Okay, the total student count. So what are the total number of students? First, we have to find the total number of students. So to find out the total number of students, it is very important that we add all these numbers. Okay, this will give us the total number of students. So 40 plus 55 plus 20 in STEM, then 35 plus 45 plus 30 in arts, like this. Or you can also count like this: 40 plus 35 plus 90 plus 120 plus 25 in grade 6, and 55 plus 45 like this in grade 7. And then, so basically we add all the numbers. So how many numbers are there in total? You have 15 numbers, if you remember. Okay, 5 rows were there, 3 columns were there. So 5 times 3, 15 numbers we have. So if we add all of them, we get 710 students in total. Now, we want to find out grade 7 honors program students' relative frequency. So, of course, we have to find out how many grade 7 honors students are there. How many grade 7 honors students are there? So, let's go back to grade 7 honors students. How many such students are there? For grade 7 and honors, you have 80 students. So 80 out of the total 710 have taken is the relative frequency. Okay. So 80 students you have. So what will be the relative frequency? Relative frequency will be 80 divided by 710, which is nothing but 11.2%. Okay. So this is a very simple example of a contingency table. Now the same question could have been asked in another way. They could have asked you to find out the relative frequency based on not the total student, but maybe uh, only based on the total number of class 7 students. So then you would divide 80 by the total number of class 7 students. Okay. So we be very careful what is being asked in the question. Okay. So this was the example of contingency table. Okay, now let's discuss data visualization. Now, visualization, it actually plays a very important role in modern financial analysis, because instead of looking at long tables of numbers, we simply convert the data into pictorial formats, visual formats, okay, which allows us to instantly see patterns, okay, relationships, even anomalies, okay. So different insights can be revealed. Now, as the saying goes, a picture is worth 1,000 words. So a well-designed graph or any dashboard can communicate the insights that would generally take paragraphs of explanation, because the idea is simple. Our brain processes visuals much faster than the text information. Effective visualization, it actually helps us detect relationships between different kinds of variables, uncover hidden structures, identify outliers, and also extract valuable insights from the data, which actually supports better decision making. So, in quantitative analysis, visual exploration is often the first step before any kind of formal modeling starts to take place. Okay, now this is a table from the CFA Institute book, which we'll use as a reference. Okay, it provides the underlying frequency data that we'll refer back when we'll explain visual tools like histograms, charts, heat maps, scatter plots, all these things. So you can see that it groups the periodic returns into different bins, okay, and shows how often the returns will fall within each range. Okay, so for each bin, we see both the number of observations and the percentage of the total. Okay, relative frequency is also given. Okay, along with the cumulative totals as well, again in absolute terms and in percentage terms. Okay, so for example, if you see, let's go to this part over here. Okay, nearly 90% of the data, okay, they fall at or below a 1% return. Okay, while of course extreme outcomes are quite rare. Okay, you can see that absolute frequency of these extreme outcomes is quite rare. So overall, this table, it organizes the raw data and it sets the numerical foundation for all the graphical displays that we'll use just after this slide to visualize the return distribution. Okay, let's start with the purpose of a histogram. So a histogram actually presents the distribution of numerical data by using the height of each bar to represent the frequency of observations within a given bin or interval. Okay. Now we can review the key features of a histogram. See, the important thing is that the bars will be equal in width because each bar represents the same return interval. Okay, so in this example, each bin covers a 1% range of daily index returns. Then there will be no gaps between bars. So the bars are drawn with no gaps at all, which reflects the continuous nature of the return data. Okay, small gaps may be added for readability, but the bins themselves will be adjacent. Okay, now this structure actually allows us to quickly assess the shape of the distribution, where the center lies and how widely the returns are actually spread. Okay, it also helps us to reveal patterns like symmetry, skewness, clustering, even the presence of outliers, extreme values in the tails. Okay. So if you look at this example, the histogram which is shown over here, again, it uses the same data set from the CFA Institute table that we have given. So the x-axis, it shows the return bins, okay, and the y-axis shows the absolute frequency for each bin, okay. Now you see the tallest bar, this one, it actually corresponds to the 0 to 1% range, this bar, the tallest one, okay, with more than 500 observations as you remember from the table. Okay, so this makes it the most frequent outcome. Now, although the distribution appears roughly bell-shaped, okay, but the bars to the right of 0 are generally a little taller, you can say, okay, overall to the right of 0. So this indicates that a greater proportion of daily returns are positive. Okay, and it was consistent with our earlier observation that over half of the returns are above 0. Okay. Now it is also worth noting one thing which we should also note over here is that histograms can be constructed using either absolute frequencies that we have done in this case. We can also use relative frequencies. So an absolute frequency histogram, it actually answers the question, how many observations fall into each bin? Whereas a relative frequency histogram, it shows the proportion or percentage of the total observations. Okay, so the choice will depend on the question that we are trying to answer. Okay, now let us look at frequency polygons as well. Okay, so in the same exhibit, in the same diagram, actually, with this histogram, on top of this histogram, you also have this frequency polygon with a dotted curve. Okay, so frequency polygon is, you can say, another way to display a frequency distribution. It is constructed by plotting the or connecting the midpoints of each histogram bin on the x-axis and frequency for that bin on the y-axis. Okay, and then connecting these points with the straight lines. Okay, so in this diagram, this frequency polygon is drawn on top of the histogram. Okay, so for example, again, if you see the let's say the 1 to 2% return interval, it has a frequency of say close to 110. Okay, so we'll plot its midpoint say at 1.5 between 1 and 2 you'll have 1.5%, right? So at 1.5% on the x-axis and the frequency 110 on the y-axis, and this will be our point. Okay, 1.5 comma 110. Okay, so by connecting the bin midpoints, the frequency polygon, it actually traces out this kind of a curve that displays the frequency as an area under the line. Okay, this makes the overall shape of the distribution quite easy to see, and it also makes frequency polygons quite useful if you are doing comparison or you are comparing multiple distributions on the same chart. Okay, and also comparison between multiple data sets. So in practice, these frequency polygons are generally used alongside the histograms to reinforce our understanding of the shape of the distribution. Cumulative frequency distribution chart. So A cumulative frequency distribution chart, it plots either the cumulative absolute frequency or the cumulative relative frequency on the y-axis against the upper limit of each return interval on the x-axis. Okay, so this chart you can see over here. It is an example again from the same exhibit. So it allows us to see the number or the percentage of observations that lie below a certain value. Just the classic definition of the word cumulative applies even here. So we have done this multiple times: cumulative frequency, cumulative distribution function, cumulative density function. Okay, so the idea is the same. What percentage of the observations lie below a given return value? Okay, and it is actually very useful to understand how data accumulate across the distribution. So this chart, if you see this cumulative distribution chart, it is again using the cumulative frequency columns from the same example. Okay, so specifically, as I mentioned, that you have cumulative frequencies which are plotted against the upper limit of each bin. Upper limit, remember that. Okay, so you notice one thing, that the curve is relatively flat in the extreme regions over here and over here. It is relatively flat, at least as compared to the middle part, much flatter. Okay, this happens because very few observations fall into those bins, into those extreme return bins. Okay, whereas the curve becomes very steep in the middle of the distribution. This reflects that most of the daily returns, they are concentrated between -1% to +1%. Okay, in fact, if you see from that chart, that table, approximately 81.5% of all the observations will fall within this central range. Okay, and this is what explains the sharp rise in the cumulative curve around, say, -1 to 1 or around 0, you can say. Okay, the steepness is very, very high. So overall, this cumulative distribution, this cumulative frequency distribution chart, it provides a very clear way to see how the returns accumulate and where most of the observations are concentrated. Okay, so this table is another reference example from the CFA Institute book that we'll use as the basis for some of the upcoming visualizations. Okay, so it summarizes one of the portfolio's holdings across two categorical variables. You have the sector and the market capitalization. Okay, so the rows, they actually show 5 sector categories, and the columns, they are showing, basically they are breaking down the holdings into 3 categories. You have the small size market cap, then mid size stocks, and the large cap groups. Okay, along with the totals, of course. So each cell basically reports the number of stocks held in a specific, you can say, sector and size combination. So this is the same RDA that we have discussed before, contingency tables. Okay, so this type of contingency table, it is organizing multi-dimensional categorical data into this compact structured form. Okay, so even though this table is informative on its own, but still patterns and comparisons, they will actually become much clearer if the same data are presented visually. Okay, so in the next slides, we'll actually use this table to construct bar charts and other graphical tools to better compare categories and highlight different kinds of portfolio concentrations. And also we'll use some other examples to see certain other kinds of visualizations. Okay. Okay, now let's start bar charts. Okay, so bar charts are used to display the frequency distribution of the categorical data. So in this one, in this case, we are discussing a simple bar chart. Okay, so in a simple bar chart, each bar represents a distinct category, and the height or even length, you can say, of that bar is actually proportional to the frequency of that category. Okay, so this makes bar charts, simple bar charts, quite ideal for comparing categories. Okay, now this bar chart shown here is actually constructed from a frequency distribution table, uh, the same table that we have done earlier, that contingency table. Okay, it summarizes the number of stocks held in each sector of the portfolio. So when you go back to this table, basically we are considering this bar chart sector wise. Okay, so we have 5 sectors, and you can see we have 5 sectors over here, right? Okay, so you can see that unlike histograms, the categories on this bar chart are mutually exclusive groups. Okay, they are not numerical bins. So this example, we are using a horizontal bar chart. You can also have vertical bar charts, okay, where the height will be represented in the height will be basically proportional to the frequency. But in this case, we are talking about the length, okay, because we are using a horizontal bar chart where what is the x-axis showing? X-axis is showing the frequency, and this will be in the y-axis in the vertical bar chart. Okay, so if it's a horizontal bar chart, the x-axis is showing frequency and the y-axis shows the sectors. Okay, and as you can see that the length of each bar, it represents how many stocks the portfolio holds in that particular sector. So obviously, if you go to that table earlier, you can see the health care sector is having the maximum number of stocks. So that is why in this bar chart also, you can clearly see that healthcare sector, it has the largest exposure. Okay, while utilities has the smallest number of holdings. You can see that in this table also, utilities has the smallest number of holdings. Okay, now let us come to grouped bar charts. So in a standard bar chart, a simple bar chart, we were displaying the frequency distribution of one categorical variable. Okay, but when we need to show how two categorical variables interact, okay, we will use this grouped bar chart. Okay, two or even multiple categorical variables, in fact. So in this case, the chart is displaying clusters of bar so that we can compare subcategories also. Now in this case, we are comparing two categorical variables. Okay, we are showing two categorical variables. So in this case, the chart is displaying different clusters of bars, right? So that we can also see subcategories within each main category. So for example, if you are using the same data, okay, the sector and market capitalization, we are creating this grouped bar chart where the y-axis again lists the sectors, and within each sector we have 3 bars. Okay, one for each market cap category. Okay, so each bar within a cluster should have its own color, and these colors should remain consistent. You can see green, green, green. They should remain, green is for small cap. Okay, they should remain consistent across all the clusters. Okay, so the bar for each subgroup, it should also appear in the same left to right order or top to bottom order. Since we are using a horizontal bar chart, we are seeing top to bottom order. The order is the same. So first you have small cap, then mid cap, then large cap, and this is consistent across all the 5 sectors. Okay, so that it will be helpful to maintain clarity. Okay, so this format, this grouped bar chart, is actually allowing us to observe both the overall sector counts and the differences across the market cap level. So from such a chart, we can immediately spot that this small cap healthcare stocks. So even in healthcare, you can see small cap healthcare stocks, they form the largest subgroup. Okay. And overall, even if you see overall, I mean, small cap stocks are tending to dominate across all the sectors, except in utilities, where mid cap stocks are little high. Okay. So that's the idea for grouped bar chart. And then finally, you have stacked bar chart. So another way to display that joint frequency of two categorical variables is with this stacked bar chart. So in its vertical form, in this case, we are taking it in vertical form. The bar for each main category you can see is divided into different segments. Okay, where each segment is representing one of the subgroups. Okay, so segments are actually stacked on top of each other, one on top of each other. Okay, and of course, just like the grouped bar chart, they are shown in different colors, and the color coding has to be quite consistent. Okay, the order also should be consistent, and the color scheme, the colors which we are choosing, that also has to be consistent. Now, if you see the total height of this bar, the total height of this bar will reflect the overall marginal frequency for that particular category. So for example, if you see the total height of healthcare, it will be same as 435. You can see that very clearly over here. Okay, so 435. Okay, so this previous grouped bar chart basically has just been expressed as a stacked bar chart in this slide. Okay, so if you are plotting this way, each sector is having a single bar which is being composed of, you can say, color coded sections, and it actually also it also makes it quite easy to see both the total count for the sector and how that total is divided into different subgroups. Okay, so that's it for the three kinds of bar charts. Okay, now let us discuss tree maps. So a tree map is another way to visualize categorical data, especially when we want to see how categories compare in size. Okay, so each category is represented by a rectangle. Okay, and the area of that rectangle is proportional to the frequency or the value. So when we apply this to those sector frequencies in that table, for example, those GICS sectors, the largest rectangle immediately tells us which sector dominates the portfolio. Okay, so in this example, again, the healthcare sector was dominating the portfolio. Healthcare will stand out because its rectangle has the largest area. Now, even in healthcare, even in this segment, you can see it has been divided. This green has been divided into three different green colors. Okay, so where you have under healthcare, you have small cap, mid cap, and large cap. Okay, so basically you can say the area of each sub rectangle also is reflecting its frequency. Okay, so this is making it quite easy to identify which subgroup is actually driving the overall category, again, such as, you know, small cap healthcare over here, very clearly visible, most significant segment it is. Okay, now of course there are a lot of advantages. The advantage is that it actually makes use of space quite efficiently. It shows proportions quite clearly. It can display nested categories, and it has an immediate visual impact, but there is a limitation also. Okay, there is a limitation that it may not be as readable as the other visualizations. Okay, because if suppose the hierarchy grows beyond 2 or 3 levels, this tree map will actually become visually very dense. So overall, the tree map, it offers a very powerful way to compare both the two categorical variables, in this case size, it can be composition also. Okay, and at a glance, it gives it at a glance, and it makes it ideal when space is a little limited, and the proportional relationships actually matter. Comparability is quite convenient if you see from this tree map just by looking at it. Okay, fine. Let's move on to the next visualization. Word clouds. So word clouds basically help us visualize textual data by scaling each word. Okay, they display the words with size proportional to their frequency. Okay, so they also remove common filler words. Okay, and by removing that, the visualization will highlight the terms that actually drive meaning, and they provide quick insights into the main themes and sentiment in unstructured text or unstructured data. Now, they are quite common and useful when you are analyzing large bodies of narrative information. You can have, say, earnings call transcripts, you can have news articles, you can have MD&A sections, social media content. Okay, because see, word clouds, they quickly reveal dominant topics and the underlying sentiment, whether it can be positive sentiment, it can be negative sentiment. Okay, so word cloud basically kind of it converts unstructured text into a clear and a visual summary. Okay, and it allows us to see instantly what a document is emphasizing and what kind of tone it is conveying. Okay, okay, now let's see the next visualization, line charts. Okay, now line charts are one of the most effective ways actually to visualize data over time. Okay, so they they excel at showing changes over time by connecting the data points with line segments. So let's take this example. Okay, so this is again another reference which has been taken from the book, okay, the CFA Institute book, where the 10-day closing prices of a company has been shown, okay, and time has been shown on the x-axis, price in dollars of that particular stock, say ABC stock, on the y-axis. So each daily observation basically is plotted and then it is connected with straight line segments. Okay, so very simple way. And by linking these points, the chart clearly shows how this stock price or this variable moves from one day to the next day. And of course, it will reveal direction as well as momentum. Okay. And it will, you can say, it will reveal the rate of change or the pace of change far better than any table can. Okay. So it helps you to identify trends. So once the data are plotted, patterns will emerge immediately. You can see uptrends, you can see downtrends, you can see turning points. Okay, you can even see periods of stability. Okay. Now, the ability to highlight these peaks, these troughs, okay, these turning points, shifts in momentum, this actually makes line charts quite fundamental to time series analysis. Okay. It also helps to compare multiple series when they are displayed together. You can give each line a distinct color or a distinct style. And in this case, you can see that this stock price has been compared with a sector index. Okay, and several indicators can be examined in parallel. So you can see because there is this sector index it has a different range, right? So that is why you need to have a secondary axis. It cannot be plotted on the same axis. 58 to 50 to 58 or 50 to 60 is a completely different range as compared to this range. Okay, so we plot a secondary y-axis, you can say, and this comparison, if you see, it helps you to determine if ABC's price movement, it actually reflects the sector wide effects or company specific factors. So if you see very carefully, the sector is actually moving in the opposite direction of ABC stock in this particular example. So it means that the decline, the sharp decline, is not because of the sector, because sector is performing well. This sharp decline maybe is because of some firm specific issues. It can maybe because of some potential overpricing of the IPO. It can be because of some management hiring or firing or some key people leaving. So anything can happen rather than general industry conditions. Okay, so line charts are quite useful. Okay, now let's move on to bubble line charts. Now, sometimes any single unit, single observational unit like the ABC ink in the previous example, it can have more than two variables that we want to analyze together. Okay, so a standard line chart will show only two dimensions. So to add a third dimension, we will replace the markers with bubbles, okay, whose sizes will depend or they will actually represent the additional variable. Okay, so this will create this kind of a bubble line chart. So if you see this chart over here, revenue is plotted over time. Okay, in the y-axis you can see you have revenue over time, and each data point is actually displayed as a bubbles which is actually sized according to EPS. You can see the green zone represents EPS profit and the red bubbles, they represent EPS loss. Okay, so this color is adding another layer, green for indicating profit, red for indicating loss. So this visualization actually reveals patterns which are not obvious from revenue alone, right? For example, like ABC is highly volatile earnings. So EPS begins in a positive way, okay, with a positive number 1.37, and it swings quite sharply to a large loss by quarter 4 of year 1, and then it again recovers in quarter 2 of year 2 before returning to a significant loss by again the second year end. So this bubble line chart is showing both revenue movement and earnings performance in a single integrated view. Okay, so they are ideal for displaying revenue trends alongside profitability metrics. Now let us move on to scatter plots. So a scatter plot actually visualizes the joint variation, how two numerical variables move together. It plots them by as coordinate pairs on this XY grid. Okay, so in this example, you can compare monthly sector returns with S&P 500 returns over a 5-year period. This graph has been drawn for. Okay, this scatter plot. So we have a IT sector and it shows a very clear upward sloping pattern. Okay, it indicates some kind of a positive relationship with the market S&P 500 in general. So when S&P 500 rises, the IT returns generally rise as well. Okay, so the points are also relatively tight, which indicates a strong correlation. Whereas if you see the utility sector, it displays a much more dispersed pattern with no obvious slope. Okay, so this suggests little to no linear relationship between utility sector returns and the broader market in general S&P 500. Okay, so scatter plots are extremely useful because they actually help us to detect relationship. Okay, whether a relationship even exists or not, but also its direction, whether it is linear or non-linear. Okay, and also the strength of that relationship through how tightly the points are clustering. Apart from that, they also help us to detect outliers and extreme values. Okay, so that is the idea. Okay, yeah. So these are the patterns. If you have a positive slopes, means variables are moving together. Negative slope, variables move in the opposite direction. No clear pattern, no relationship. Tight clustering, strong association. Loose clustering, a weak association. Okay. Now let's move on to scatter plot matrix. So scatter plot matrix, it actually organizes all the pairwise scatter plots among multiple variables into a single visual. Okay, so you can see this is a scatter plot matrix. So you have 4 return series which have been plotted over here. Okay, so we have S&P 500, IT, utilities and financials. Okay, now you see one thing, basically all have been plotted against each other. Okay, so you notice one thing, the diagonal elements basically, or the diagonal plots, they seem to be a bit different, right? Because the diagonals are plotting the variables with respect to themselves only, the sectors with respect to themselves only. Okay, or the broader market with respect to itself only. Okay, you can see this very clear, and that is why the plotting with respect to itself. Now, if you remember, this is exactly analogous to what we study in the covariance matrix, where the diagonal elements basically represent the individual variances. Okay, so this diagonal panel, it actually represents a bivariate scatter plot. Okay, sorry, each non-diagonal pattern. These patterns, they are actually a bivariate scatter plot because we are talking about two variables, whereas the diagonal elements, they are showing the distribution of a single variable in this case. Okay, so diagonal panels, univariate histograms for a single variable, off diagonal panels, bivariate sector plots, and it provides quite a compact overview of all the relationships. So it makes it easy to compare relationships across all sectors at once. You can see that in this case, the S&P has a strong positive relationship with financials also. I mean, IT we have already seen, the IT relationship we already see. Even with financials, it has a strong relationship. Okay. Whereas if you see, say for example, say financials and utilities, because utilities itself was having a limited or very weak relationship with the market in general. So you could expect that maybe financial and utilities will also not have a very strong relationship, although this may not be always 100% true, but yeah, more or less you could have expected that, and that is what is happening. Financials and utilities are not having a strong correlation. So it's a weak relationship. Okay, so scatter plot matrices, what are the advantages? They quickly reveal direction, form and clustering strength. They enable comparison across multiple sectors simultaneously. and they are actually built-in function in many statistical softwares. Okay, but remember one thing, they are not substitutes for formal statistical tests. Okay, so they should just be complementing, not replacing formal statistical tests. Okay, even though they offer a very efficient way to screen for these patterns and correlations, but they have to be calculated, tests have to be performed separately. And now let us come to the final visualization, the heat map. Now, a heat map basically displays data in a table while using the colors to show the magnitude of each value. So basically, you see, it is quite analogous to a contingency table with color coding, you can say. Okay. So in this example, you see the same portfolio, basically the same portfolio whose stock holdings were there across different sectors and different market cap groups have been shown in the form of a heat map. So each cell is representing those same numbers. If you let's go back, okay, to that example, you can see communication small cap is 21. Okay. So if we go back to that example, communication small cap, communications, I think the number has been changed in that case. I don't think then the same example is being used. Let me just go back. Communication small cap in this case is actually 21. Okay. So each cell is basically representing the number of holdings in a particular sector cap combination. Okay. And the color scale will actually highlight high versus very low exposures. So you can see the legend is drawn over here. The blue, the more the blue it is, the less the frequency is, and the more the heated, or you can say orange or yellowish it is, it actually shows high exposure or high frequency. Okay. So you can see that, okay, the lot of small cap stocks are there, 99, 81. Yeah, this is from a different example, right? Because utilities, there are too many holdings over here, too many stocks. So this is not that same example. Okay. So heat maps, they actually provide a very quick and intuitive picture of concentration as well as diversification. Okay. And beyond the frequency data, they are also commonly used to visualize correlation matrices also. Okay. And it helps the analyst assess relationship between different variables. Okay. Now, how to select the visualization type? Now first we need to understand the distribution. So before choosing a chart, the first question is whether we want to understand the distribution of a single variable or not. So in those cases, we will use histograms, frequency polygons, or cumulative distribution charts to show how data values are distributed, how where observations are clustering, how wide the spread is, and how heavy the tails are. Next is comparison. If suppose the goal is comparison rather than pure distribution, we basically want to compare categories, or we want to track changes across time periods. So we move to bar charts, tree maps, heat maps, line charts, all these things to compare categories or trends over time. Okay. So as we saw that these visuals, the bar charts, tree maps, heat maps, line charts, they actually help us to highlight a lot of things. Okay, sometimes the relative size, movement also through periods, which period stands out, how performance is differing across segments. So that is why these type of charts should be used while comparison. Now if you are interested in relationship, okay, in how two variables move together, then actually we use scatter plots, bubble line charts, even heat maps in this case also, okay, to explore relationships between two or more variables. Okay. And if suppose the number of variables grows, then the individual plots will become inefficient. Okay. So a scatter plot matrix in that case, or again a heat map. So heat map is quite versatile in its usage. So in this case, if you are analyzing multiple variables, then scatter plot matrix makes sense to analyze the pairwise relationships across many variables simultaneously. Okay, so that's it for the visualization part of this chapter. Okay, now let's start with the next section, describing data. So till now, what we have done in the first part of this chapter, we focused on organizing and summarizing data. We used tools like frequency distribution tables, contingency tables, mainly to structure the raw observations. Okay, and in the second part, we built on that foundation by visualizing the data, where we used charts, graphs, etc., to reveal patterns and relationships more, you can say, intuitively. Okay, now here we are going to focus to the next step, which is describing data using numerical measures, okay, which is known as descriptive statistics. So we'll describe the key characteristics of data, okay, rather than relying on tables or visuals. These characteristics, these measures, uh, they will actually use numbers. Okay, so these measures which will summarize key characteristics of a data set, they will use numbers. And these statistics, they will help us answer some fundamental questions. What questions? Questions regarding location, dispersion, position, etc. So for example, where are the data centered? Okay, regarding the location, how widely they are spread. Okay, and where do the individual observations lie within the distribution. Okay, so we'll begin with measures of central tendency like mean, median, and mode, which will describe the center of the data. And then we'll expand to other measures of location, okay, and measures of dispersion also. Measures of location will include quartiles, quantiles, all these things, and measures of dispersion will include variance, standard deviation, etc. Okay, so in context, in the CFA context also, and in general also, these summary measures, they are referred to as statistics. Okay, because analysts almost always work with samples rather than the entire populations. Our focus will be on sample statistics. Okay, because they form the foundation for financial analysis and risk assessment. Okay, let's discuss measures of central tendency. Now, a measure of central tendency, it tells us where the data are centered. Okay, so what a typical or a representative value looks like in a data set. Now, let's start with arithmetic mean. So, arithmetic mean is the first measure, which is simply the sum of all values divided by the total number of observations. So it is the most commonly used average and is widely used in finance. Again, don't discuss the cases of uh, unequal probability, okay, because that's a whole different discussion altogether where we calculate the weighted means, and it will come later on. Okay, so that is based on probability. Over here, we are calculating simple arithmetic mean. Next, you have the median. So median is the second measure. It is the middle value. Once the data are sorted, okay, and it is resistant to extreme values or outliers. So actually, median is much less influenced by outliers as compared to the mean. Okay, because you are taking the central value. So even if you have an outlier, your central value will not change. Maybe it will just change by a location. Say one unit you have to shift to the right, or one data point you have to shift to the right, or maybe you have to take the average. In fact, we have shown this in great detail in the sample movements chapter, where we have discussed why median is actually much more robust to outliers. Okay, so I'm just introducing this over here. We'll see the examples in the core readings, okay, and the other chapters. Then you have mode. So mode is the third measure. It is the most frequently occurring value in a data set. Okay, and this measure is quite useful when you are dealing with categorical or discrete data. Okay, so we just discuss the arithmetic mean in a little more detail. So this is the formula, as I said, the average of all values in the entire population, summation of xi divided by n. Okay, so basically this formula, if you see, this is about the population mean, the average value of the entire population. And over here on the right, you have the sample mean. Okay, x bar or x cap. Sometimes actually it's x bar. Bar is missing over here. Should be x bar. Okay, so X bar is the average X bar. X bar is basically the average of a subset of that population, which is basically the sample. So concept is same, sum the values divided by the total number of observation. Okay. Now, as I said, the limitation is what? The limitation is that it is extremely sensitive to outliers, especially if the distributions are asymmetrical, and it works best with symmetrical distribution. Just one extreme value can pull it sharply upward or downward. Now, why the mean matters? So, why the mean is such a big deal in finance? See, the mean gives us the typical value or typical outcome of a data set. Okay, a single number that can summarize all the observations. So, it is like an anchor that we can use to understand what is normal or expected. Okay. Now, one thing is important is that sum of deviations from the mean is always equal to 0. This is an important mathematical property. If you take every data point and if you measure how far it is from the mean, some will be above, some will be below, but we will find that the total will always come back to 0. Okay. In fact, we can demonstrate this quite easily. We have done this in other chapters. We can do it quite easily. So you can verify it yourself. So this balancing property is why the mean behaves like the center of gravity of the data. Okay. Also, it is used to compare performance. Okay. In practice, analysts will use the mean regularly to compare the performance, whether it's about, say, stock markets or sectors, portfolio returns, specialized portfolio returns, diversified, undiversified, any kind of portfolio returns. So it actually helps us to answer questions like, uh, which region performed better, you can say, which strategy delivered higher returns, average returns, okay, higher average returns. Now there is an idea called as cross sectional mean, which is again related to what we have done regarding cross sectional data. So cross sectional mean, it actually compares units at a single point in time, and you have time series mean. Okay, time series mean, it measures how something behaved over time. So for example, if the average monthly return of the, say, Nifty 50 we are wanting to, say, assess over the last, say, 5 years. Okay, so this actually gives us a sense of long-term performance as well as trends. Okay, but if you see for cross-sectional mean, basically you can say, for example, the average, say, return on equity of 30 companies today. So that is actually helping us to compare peers in the same period. Okay. Now let us come to the situation of outliers. So when a data set, it includes extreme values, the arithmetic mean can actually become distorted. The mean may not represent the center well. Outliers can pull the average sharply either in upward direction or downward direction, and it makes it less representative of typical outcomes, which was a very important property, you can say, or utility of the mean. Okay, that utility itself is gone now. So how do you handle the outliers? The first option is to do nothing. If the extreme values, they are legitimate, okay, you find that they are market observations which are legitimate, they reflect real conditions, we'll keep them. Okay. So outliers can sometimes carry important information also. Okay, especially during the periods of market stress where you can expect some outliers. Okay. The second option is to remove the extreme values. So by trimming a small percentage of the highest and lowest observations, okay, we calculate a trimmed mean that will focus on the central portion of the data. Okay. So for example, if you have 5% trimmed, so basically you drop the top and bottom 2.5% of the data and you get a trimmed 5% mean or 5% trimmed mean. Now this is quite useful when extreme points, the outliers appear, some kind, in some way they appear unrepresentative of the data. So you can just remove them. Then there is another option, Winsorizing the mean, Winsorized mean. So instead of deleting these extreme values, we actually replace them with the nearest threshold values, you can say, or the nearest percentile threshold. Okay. So capping the lows and the highs. Okay, instead of deleting them. So this keeps the full sample size intact while reducing the influence of outliers. So basically, the let's say we are Winsorizing, and what we'll do, we will replace, let's say we are going for 5% only. Okay, so the top 2.5% of the data, we are changing all the values to that 97.5th percentile, basically just at the boundary value that we get. Okay, before we assume that, okay, beyond that we are having extreme values. So beyond that, we are not removing those values, we are just replacing those values with that extreme, that end threshold value. Okay, that last value basically. Okay. Okay, now let's come to the median. So this is another very important measure of central tendency, the median. So the median identifies the middle value of a data set when arranged in ascending or descending order. Okay. Now, if the sample size is odd, then it's not a problem. The middle value simply is a single value, it becomes the median. We're talking about discrete data set. And if the sample size is even, then the mean will become the average of the two middle values. Now, what are the advantages of the median? See, of course, one of the key strengths of the median is that it is not affected too much. It is affected very little by extreme values. Okay, so even if the data set includes, say, very large or very small outliers, the median will remain relatively stable. Okay, so this actually makes it very useful for financial variables like revenues or ratios, which tend to be skewed sometimes. And finally, the median actually, yeah, it better represents typical value in skewed distributions. And finally, it divides the data set into two equal halves, as you can see in the figure. Of course, this is a symmetric case. So it is possible that even if the distribution is not symmetric, okay, you will have the median which will divide the data set into two equal halves, where 50% of the observations will lie above it and 50% of the observations will lie below it. So this makes the median a very effective representation of the typical value when data are not symmetrically distributed in particular or where there are outliers. And let's finally discuss the mode. Okay, so this is you can say the simplest measure of central tendency. Okay, this is the value that appears most frequently in a data set. Okay, so any distribution can behave in different ways. Any data set can behave in different ways. So a distribution can have either one mode. If one value occurs the most, it is having one mode, and it will be said to be unimodal. If two values, say, tie for the highest frequency, okay, both of them are having the highest frequency, we call them as bimodal. And if three values dominate, trimodal. And let's say if every value is unique, then technically the distribution has no mode. Okay. Now, when I talk about continuous financial data, for example, like stock returns, okay, we we often don't get repeated exact values. Okay, but once we group them into bins, then the bin with the highest frequency will become the modal interval in that case. So basically the range where most of the observations will lie. Okay. Now the mode is the only measure of central tendency which is suitable for nominal data like fund style categories, say sectors, or credit rating labels, because you cannot average these things. You cannot average the sectors. I mean, energy is a sector, industrials is a sector. So if you take energy, industrial, healthcare, what is the average of industry in energy, industrial, healthcare? It's a category, right? You can just find out which one occurs the most. Okay. Now let us come to some alternative mean calculations. So as I said, we can have the weighted mean. So weighted mean assigns different weights to observations based on importance. Okay. So in investing, all the observations do not carry the same amount of importance. So for example, in a portfolio, the return on a stock with say 40% weight, of course, it matters much more than a stock with 5% weight in the portfolio. So weighted mean will allow us to incorporate these weights, these differences in weights, and get a more realistic measure of overall performance. Okay. Next, you have geometric mean. So geometric mean is actually the appropriate way or the correct way for calculation of growth rates and investment returns over multiple periods. So it captures the compounding effect, which makes it very important to analyze multi-period investment return. Okay, for example, like a fund's say 5-year or 10-year CAGR. Okay, whenever returns multiply over periods, we will prefer the geometric mean because the interest also earns interest. Okay, whatever portfolio you have, if that portfolio is getting say multiplied every year, I mean, let's say in the first year the return was say 10% in your portfolio. Now after that, your new portfolio actually, if you see effectively, becomes 110% of your original portfolio, right? So there is an effect of compounding and the returns are multiplying over periods. So in those cases, we will prefer geometric returns. And finally, we have the harmonic mean. Okay, so this one we'll discuss a context for this, why it is used and when it should be used. It is especially useful when you are using rates, and ratios, like say price to earnings ratios across a portfolio. And we'll see why. There is a specific property of the harmonic which makes it actually quite useful for these kind of parameters. Okay, average P ratios. Now, because ratios, they actually behave quite differently from raw values, the harmonic mean will give a better accurate combined value, you can say. Now, let's see the formulas for weighted mean. This is the formula, summation of Wi xi. This is the formula for geometric mean, the nth root of x1, x2, x3, xn. In fact, when you actually go for returns, for geometric mean return, there will be a slight variation in the same formula. Remember that there will be a slight variation in the same formula. Okay, the structure will be a little different, but yeah, overall it will be, I should not say structure will be different, structure will be same, but there will be some variation. Okay, because when we talk about returns, we actually do 1 plus r, 1 plus r, like that, 1 plus r1, 1 plus r2. Okay, nth root of that, and then we'll subtract 1 also later on. And then for harmonic mean, this is the idea, the number of observations divided by the sum of the reciprocals of individual data points. Okay, so we'll see some examples after this slide so that it becomes more clear for you. An example of AM, GM and HM. Okay, a portfolio analyst is reviewing the annual returns of 5 S&P 500 companies. The returns of the most recent year are shown below. So these are the 5 companies and these are the returns for the most recent year. Okay, Apple, Microsoft, Amazon, Alphabet, Tesla. And their returns, annual returns, range from 7.4% for Tesla all the way up to 18.4% for Apple. Okay, so these returns will serve as the input data for calculating AM, GM, and HM. And also through this example, I will clarify an important point that I mentioned just in the previous slide. Okay, the difference between the geometric mean and the geometric mean of returns. Okay, so in the previous slide only, we discussed this. Okay, that geometric mean basically is nothing but the nth root of the product of all observations. So this is how it is calculated, the nth root of the product of n values. Okay, but see, if we are calculating the mean of generic numbers, we can apply this formula directly. But when we are working with returns, we have to convert each return into a growth factor using 1 plus r, and we'll see that. Okay, then we'll take the geometric mean of those growth factors and then subtract 1 at the end, okay, to convert back into a return. Okay, so we'll see all these steps in detail when we are calculating geometric mean. So let's start with arithmetic mean first. So for arithmetic mean, the calculation is very simple. Okay, since they are, I mean, nothing is mentioned regarding the weights or the probabilities. We'll just calculate the simple arithmetic mean, which will be the sum of all observations divided by the number of observations, which gives us 12.68%. So this arithmetic mean is pretty straightforward. Now let us come to the geometric mean return, okay, for the same S&P 500 companies. Okay, so what I said, the key step is that we do not use the raw returns directly. Okay, first we convert each return into a growth factor by adding 1. Okay, and we take the tth root. Okay, depending upon the number of observations, if there are t observations, we take the tth root. Okay, and then we subtract 1 finally. So Apple's 18.4%, it actually becomes 1.184. Okay, Microsoft 12.26% becomes 1.126 and so on. Okay, and finally Tesla's 7.4% becomes 1.074. So these are all the growth factors. Now we are just multiplying all these growth factors together. Okay, so it gives you 1.8111. Okay, and we take the fifth root because we have 5 observations. We take the fifth root of this product. Okay, and the fifth root of this product actually gives us 1.1261. And every time, I mean, right from the start, we are subtracting a 1. Okay, to convert the growth factors back into a return. Okay, so the geometric mean is actually 0.1261, or you can say 12.61%. Okay, this is a very important step. See, this calculation, it actually enforces a very, very important rule. When you are working with returns, the geometric mean must be applied to 1 plus r and not to r directly, because the returns compound. Okay, now let us come to harmonic mean return. Okay, using the same S&P 500 companies. So the harmonic mean is calculated very differently from the arithmetic and geometric means. Okay, so we have seen that instead of averaging the returns directly, we actually first take the reciprocal of each return and then average those reciprocals, and we finally take the reciprocal of that average. So basically this is the idea, n divided by summation of 1 over xi. Okay, n divided by the sum of the reciprocals of the return. So we start with these 5 returns. Okay, we have 18.4%, 12.6%, all these 5 returns are there. So we take the reciprocal of each of them and we add all of them. Okay, and then we divide 5 by this total number. Okay, so when we do that, the denominator will become 0.4367 and you will have 5% in the numerator. And when you divide it, okay, you will get 11.4501%. Okay, now I try to be, as I say always in my classes, that I try to be as mathematically precise in terms of, applying the units and percentages very consistently. Okay, you might be noticing something over here, that the numerator we started with 5. Okay, not 5%, because that was just a number of observations, but you have the percentage sign in the next step, because when you take the reciprocals, the denominator is in 1 over percent. Okay, so if you divide 5, okay, by 1 over percent, basically this percent comes to the numerator. So I try to be this the mathematically as precise as possible, especially with respect to units, consistency, these basic calculations, which you will see that many textbooks also tend to ignore, and candidates are not able to understand why suddenly, if we are actually taking percentages in the denominator, how do they come in the numerator? But this is very basic math which we used to learn in school days. Okay, now you can also do one thing. Let's say you are still confused. Okay, you can just follow the decimals approach to avoid any kind of confusion. We can just convert each return to decimals first. So basically 18.4%, you can just write 0.184, 1 divided by 0.184, like that. Then you compute the harmonic mean, and obviously you can convert back the decimals to a percentage at the end. Okay, but see, the two approaches are going to give you the same result. Okay, but what is more important is to understand how the harmonic mean behaves. Okay, yes, we have to be technically, mathematically precise, that is one thing, but we are doing the CFA course, right? Which is more about finance and not about math completely. Of course, math is very important. We should lay a lot of emphasis on the math part also, but we are studying CFA course where finance is more important. So what is the financial implication over here? We are seeing that harmonic mean, it places more weight on lower returns. Okay, because you're taking the reciprocal, okay, of all the returns, which means that the higher the return, the reciprocal will be lower. So which means that it pulls the average down relative to the arithmetic and geometric means. You can compare it. We got the harmonic mean as 11.4501%. Let's go back to the geometric mean. We got as 12.61%. Okay, and arithmetic mean we got as 12.68%. So it is quite clear that relatively harmonic mean is lower as compared to the arithmetic and geometric means. Now, because of this property, the harmonic mean is most useful in some specific applications like averaging of ratios, okay, PE ratios in particular. And in fact, we'll see those things also later on. Okay, there are situations where you have equal dollar investments. Okay, rather than measuring multi-period portfolio performance, you need to have equal dollar investments. Okay, so even though it is less commonly used for returns, it is very important to recognize how it is calculated and why it is lower, and also when it is appropriate from the returns point of view. Okay, especially for exam related questions in the CFA exam. So understood that there are special cases where, say, you have to invest equal amount of money over specific intervals. In those cases, harmonic return actually gives you the correct result. Okay, and this will be discussed in more detail later on. Now, example of weighted mean. So let's look at an example of weighted mean. Okay, and this is how we calculate a portfolio's return. Okay, so you have a financial advisor who has constructed a diversified portfolio using four major asset classes. Each asset class will have a different weight. So weights and their most recent returns are shown like this. Okay, so each asset class has a different portfolio weight. Okay, what does the portfolio weight reflect? It reflects how much of the total portfolio is invested in that particular asset class. And that is why we use a weighted mean, because not all components are contributing equally to the overall performance, right? The portfolio is allocated 30% to domestic equity, 25% to international stocks, not equal contribution is there. Okay, so each asset class also has its own annual return, and what the formula as we discussed for the weighted mean is simply WIXI summation. This is the formula for the weighted mean. So what we do, we calculate 30% of 5% or 0.3 times 5% like this for domestic equity and so on. Okay, so this will be the weighted portfolio return. Okay, the overall weighted portfolio return which we get as 3.2%. Okay, so when investments have different weights, the simple arithmetic mean cannot be applied. You have to use a weighted mean. Okay, fine. Okay, now let us understand quantiles and percentiles. So these are tools that help us locate where an observation lies within a data set. Okay, now quartiles. Quartiles divide the data into four equal parts. Okay, Q1 will mark the 25th percentile, Q2 is the median, basically the 50th percentile, and Q3 marks the 75th percentile. And the interquartile range is Q3 minus Q1. It helps to understand the spread of the middle half of the data, you can say. Okay, so you can imagine the data sorted from smallest to largest. Okay, Q1 is basically the value where the first 25% of the data ends. Okay, so it is not a section, it is the end point. Q2 is where the first 50% of the data ends. This is the median, of course. Q3 is where the first 75% of the data ends. So these three values, Q1, Q2, and Q3, they split the data into four regions. Okay, from the minimum up to Q1 is the first quartile, then you can say, then from Q1 to Q2, then from Q2 to Q3, and then from Q3 up to the maximum level. So the fourth quartile is not a single value. It is basically the region from Q3 to the maximum value, and that's why we don't write Q4 separately. Okay, so quartiles create four parts, but to create four parts, right, only three cut points will be needed. So these Q1, Q2, Q3 are those three cut points. Okay, then we have quintiles. So quintiles are similar, but now the data is split into five equal parts. And the interesting part is that, I mean, those of you who have the experience of taking the FRM exam also, they might be knowing that FRM, the GARP releases the results of FRM Part 1 and Part 2 exam based on the quartile system for individual modules. Anyway, so quartiles are used relatively more widely as compared to quintiles. Okay. Now, of course, if they are dividing data into five equal parts, each part will represent 20% of the distribution. For quintiles, I'm saying. Next, you have deciles. So deciles divide the data set into 10 equal segments, again, each capturing 10% of the observations. And we have percentiles. Now, many of you might have heard about percentiles. So percentiles are going even further. They are dividing the data into 100 equal parts, okay, giving us much more precise location of the, say, different information sets. Okay, now to find out the position of the yth percentile, okay, you have, and of course we are talking about a sorted data set. So we use this simple formula: n plus 1 multiplied by y divided by 100, where n will be the number of observations, y will be the percentile we want, and ly will be the position of that percentile in the sorted data. Okay, so if suppose we have, say, 49 observations, let's say, okay, just to make it simple. So 49 plus 150 multiplied by y by 2. So y is the percentile that you want. Okay, so if you have say 49 observations, it becomes 50y by 100, which becomes simply y by 2. Okay, so if you want the say 26th percentile, it will be the 26 by 2, which is the 13th observation. That's it. Okay. Now, overall, quantiles, they help us to understand the distribution, and they identify, or you can say pinpoint, exactly where an observation stands within a data set. Okay. Okay. When I say stands within a data set, okay, I'm talking about the relative position. Even though I use the word exactly, identify or pinpoint exactly where an observation stands within a data set. It means what is its relative position within a data set. Okay, now let's look at how quantiles are actually used in investment practice. So quantiles are everywhere, you can say, in performance evaluation. Okay, in the investment world, they are widely used in performance evaluation and investment research. Okay, investment managers, in fact, they are ranked by quartiles or percentiles relative to their peers. For example, you have Morningstar ratings. Okay, Morningstar, it uses the same idea when they assign star ratings. Okay, so stars are based on percentile rankings relative to the similar funds. Okay, so you will actually, when you are into the investment analysis domain, you'll see here, and you'll actually hear analysts say things like, this manager is in the top quartile, this manager is in the top 10 percentile, or anything like that. Okay, even the bottom decile, bottom quantile, or bottom deciles are also quite important. Okay, so the companies whose returns, they fall below the 10th percentile returns, they are known as the bottom return decile. Okay, so analysts can quickly isolate the weakest performers. Now, sorting the firms into quantiles, like for example deciles or quintiles or quartiles based on market value, it also helps in you can say comparison in strategy analysis. Okay, like for example, if you sort the companies into deciles based on, say, their market capitalization. Okay, so first decile will hold the smallest companies, and 10th decile will hold the large cap companies, the biggest large cap companies. Okay, so researchers can compare whether small cap stocks are outperforming or large cap stocks are outperforming, something like that. Okay, depending upon the objective. Quantiles, they are not just statistical tools. Okay, so they actually support strategy development by revealing the relationships between firm attributes as well as returns. So they are quite central to evaluating performance, quite central to building strategies, and also understanding the relationships in financial data. Okay, now let's move on to measures of dispersion. Dispersion measures, they quantify the variability or spread in a data set. So how spread out or variable a data set is, okay, that is quantified by dispersion. And in finance, dispersion is directly linked to risk and uncertainty. So the greater the dispersion, the higher the potential variability in the outcomes. So the first measure of dispersion is the range. So the range is simply the difference between the maximum and minimum values in a data set. So it is very easy to compute, very simple. It gives a very quick sense of the spread, but because it depends on only two observations, it is highly sensitive to outliers, and that is why it is unreliable as a standalone risk measure. So formally it is calculated like this: range is equal to maximum value minus minimum value. Then you have mean absolute deviation, the second measure, MAD. So mean absolute deviation, it measures the average absolute distance of each observation from the mean. Okay, so we are talking about distance, and it makes it quite intuitive again, a very intuitive measure, very easy to interpret. So this is the mathematical formula. It is the average of the absolute deviations from the mean. Okay, but despite its intuition, MAD is not used extensively in finance. The main reason is that this absolute value, okay, this absolute value function, it is not a very mathematically convenient function. Those who remember from school days when we used to do differentiation where the functions are differentiable or not, this is a function which is not differentiable at simply mod x. The absolute value function mod x was not differentiable at x is equal to 0. Okay, so that is the problem with this mod function, and so basically it does not work well with calculus. It even does not work well with optimization. Okay, with optimization problems, it is not very suited to work with those kind of problems. So that is why these inconveniences, they limit this MAD's usefulness in portfolio theory or in risk modeling. Okay, even statistical inference is not that great using MAD. So that is why MAD is not used in practical applications. You have variance and standard deviation. The most important dispersion measures in finance are variance and standard deviation. So variance measures the average squared deviation from the mean. Okay. And standard deviation is the square root of variance. Okay. So what is variance? Variance is measuring the average squared deviations from the mean, and standard deviation is simply the square root of this. Okay. Which will bring the measure back to the original units. Now, when working with sample data, we divide by n minus 1. We have discussed this in the previous chapter also, one of the previous chapters, not n. Okay. In fact, sorry, this not in previous chapters. This will be discussed in a subsequent chapter. But you all know that about degrees of freedom. We have had a discussion regarding degrees of freedom in the FRM class. But even if you're not aware of that, it's still okay. It will be explained, don't worry. So the idea is, see, this adjustment is basically known as Bessel's correction. Okay. And it accounts for the fact that we use the sample mean instead of the true population mean. Okay. We use X bar instead of mu in the calculation, which actually consumes a degree of freedom. Again, don't worry if you don't understand it right now, it will be discussed. Okay. Now, since the sample mean is estimated from the data itself, the important point to remember over here is that the deviations from the mean, they will tend to be systematically smaller. Okay, and because of that, the variance which is calculated with n, it will be biased downwards. So if you divide by n minus 1 instead of n, you actually correct for this loss of a degree of freedom. And again, degrees of freedom will be discussed with an example, okay, in subsequent chapters. And that will ensure that On an average, the sample variance provides an unbiased estimate of the true population variance. So that is the idea, just to remove that bias. Okay, because it becomes, if you use n, it becomes a biased estimator, especially biased downwards. So that's why you use n minus 1. Now together these measures of dispersion, they help us to measure, they help us to quantify volatility, they help us to compare risk and understand uncertainty. Okay. See, in practice, standard deviation is the primary measure of risk used throughout portfolio management, throughout asset pricing, and even performance evaluation. So that will be the most important measure. Let's look at some examples. Let's start with the example of mean absolute deviation. So a quality control analyst checks how much a machine's output varies during the day by calculating the mean absolute deviation from 4 recorded measurements. So these are the 4 recorded measurements. Okay, so first thing what we need to do, we need to calculate the mean of this sample. Okay, so mean of this sample is equal to all the observations are added divided by 4, which gives us 2. And remember, for calculating the mean, we don't use n minus 1. Okay, because it's the mean directly being calculated. Okay, for mean absolute deviation, we have 1 over n summation xi minus x bar, this formula. Okay, 1 over n summation xi minus x bar. So over here also we don't use n minus 1 in the denominators. You just take the deviations, take their absolute values, sum them, divided by the number of observations, you get 4.50. So MAD calculation is very simple. Now let's come to the most important measures of dispersion, the variance and standard deviation. Okay, so variance is measuring the spread of the data. Okay, when the observations are uh, you know uh, basically you can say how spread out the data is around the mean. Okay, so it captures how far observations deviate from the mean. So obviously if observations are too far from the mean, the variance will increase, and when they are close to the mean, variance will be low. Okay, we actually use squared deviations so that positive and negative deviations do not cancel out. In MAD also, we were making both of them as positive. We were trying, they don't offset each other, because if you calculate it without having a mod or a square, just simple deviations, you'll actually get 0. Okay, so we use square deviations so that positive and negative deviations do not cancel out. Okay, now it forms, of course, variance forms the foundation for standard deviation. And if the variance is higher, the dispersion is much higher. Okay, so this is the formula for sample variance, as we discussed earlier, that with respect to the degrees of freedom, to make the estimate unbiased, because now we have n minus 1 degrees of freedom. Degrees of freedom example is also discussed in a subsequent chapter. Okay, that when you are free to choose how many observations you are free to choose, if one of the parameters like the mean is already decided. So don't worry about that. Just remember that for sample variance, we use n minus 1 in the denominator. Okay, so it gives us the average squared deviation from the mean. And for the sample standard deviation, again, what we are doing, we are just calculating the square root of variance so that it actually comes back to the original units and it is more easy to interpret. It is most widely used. It is the most widely used measure of risk and volatility in finance. Just like higher variance, higher standard deviation will also imply greater uncertainty in returns, which is quite obvious, right? Because it's the square root of variance. It is used in portfolio analysis, risk models, and performance evaluation. So it is arguably the most important measure of volatility in finance. Okay, and this is the formula, the square root of variance. Okay, so let's take an example of sample standard deviation. You have a portfolio manager who wants to review how consistently her fund has performed over the past 5 years. So she gathers the fund's annual returns and now needs to calculate the sample standard deviation to understand how volatile the fund's performance has been during this period. Okay, so these are the data points, these are the returns, okay, in the 5 years. Now, the first thing obviously you will do if you want to calculate the sample standard deviations, assuming of course, since there are no weights are given, So we'll do a simple calculation of both the mean as well as standard deviation. So first, of course, you need to calculate the sample mean. Sample mean will be sum of all observations divided by n, which is equal to 2.5%. So that's the first step. Next, what we'll do, we'll take that table, of course, okay, and just as a recall, what we calculated, the mean was calculated as the sum of the observations divided by 5, which was 2.50. So this we have already done. Now what we do in the next step, we calculate the deviation of each observation from the sample mean. Okay, so x minus x bar or xi minus x bar. Okay, it's a bar over here. Okay, so xi minus x bar. And then we squared those deviations, xi minus x bar whole square. Okay, now when we add the squared deviations, we are getting 42.28. Okay, so how will you calculate sample variance? It will be very simple now. We'll apply the same formula. So we have this summation of xi minus x bar whole square as 42.28. We just need to divide it by 1 over 5 minus 1. N is 5, which means 1 over 4. Basically, we need to divide by 4. Okay. So this is equal to 42.28 divided by 4, which is 10.57% square. Now this is very, very important. It is in percent square, and that is why we need to be mathematically precise everywhere while we are applying the units. If we are having variance, variance is the square. Basically, you can see you have the square of the deviations, which are already in percentages. So obviously the final expression should also be, because percentage is not a unit. I refrain from calling it as unit sometimes, but let's say that it's the way of expressing. So s square should be expressed in percentages square, because the original data was in percentages. Okay, now if you want to calculate the sample standard deviation, you simply take the square root of this, and then you get this is in percentage. Okay, this you are getting directly in percentage, because the term inside the square root was in percentage square. Okay, so S is actually in percentage. The sample standard deviation for this data set is 3.2512%, and the sample variance is 10.57% square. Okay, now let us introduce an important refinement, you can say, to risk measurement, which is known as downside deviation. Okay, so downside deviation focuses only on returns below a target or minimum acceptable return, sometimes known as MAR, providing a more relevant risk measure for investors concerned about losses. Okay, so unlike standard deviation, which actually treats upside and downside volatility equally, downside deviation, okay, sometimes it is also known as semi-standard deviation, okay, it actually concentrates specifically on losses and underperformance. Okay, so downside volatility becomes more important over here, and that is what investors typically care about most. Okay, now mathematically, this is the formula. Downside deviation is calculated by first identifying all the returns. So for all xi less than equal to b. What is b? B is your target return or benchmark return, whatever, or minimum acceptable return. Sorry, I should not say benchmark return, minimum acceptable return or target return. Okay, so for each of those observations, we compute the squared deviation from the target. Okay, we add them, and then we divide by n minus 1 if we are dealing with the sample, and then we take the square root. Okay, so obviously the intuition behind the formula should be quite clear, that any return above the target, okay, that is being ignored completely. The volatility from that part is being ignored completely, because it does not increase any kind of downside risk. Okay, so only the returns which are below the target, okay, they actually contribute to the calculation, and larger shortfalls will be penalized more heavily because you have the deviations which are squared. Okay, so the key insight is this, that downside deviation better captures investor concerns about underperformance and losses compared to standard deviation. That is why downside deviation is often used in downside risk measures like say Sortino ratio, okay, which you will study later in the core readings, and why it is especially relevant when returns are asymmetric. That is also very important. Okay, when investors care more about falling short of a goal than about general volatility, you can say. Okay, so in short, standard deviation, it measures the total volatility, but downside deviation, it focuses on bad volatility only. Okay, and that is what makes it a more behaviorally meaningful risk measure in many investment contexts. So let's see an example. Okay, so a portfolio manager wants to assess how her fund performance, or sorry, how a fund performed during a volatile quarter. She selects the last 5 monthly returns and calculates target downside deviation using a target return of 2%. Okay, so this is B in this case. Okay, so this is the table that she builds. This table basically lists monthly returns from January to May. Okay, so these values, all these returns, they will help us identify which months fell below this 2% target, okay, which will be used for the calculation of downside deviation. So this was the original table which was given to us, the first two columns, the monthly returns. Okay, we are labeling them as observations xi, the raw returns that we are starting with. Okay, then you have the third column where we calculate each observation's deviation from the 2% target, which is B. So that is basically xi minus 2% we are calculating. Now, strictly speaking, this column is not required, okay, to compute the downside deviation, because we are going to use something else after this. But it is just shown here as an intermediate step to clearly illustrate how each return compares to the target return. Okay, and to make the logic of the next step more transparent. Okay, especially for learning and exam clarity. Next, you have deviations below the target. So in the fourth column, we will focus only on the returns that are below the target through this min function. So basically, when I say min 0 comma xi minus b, whatever returns are positive, those are completely being ignored, because the minimum between 0 and a positive number will always be 0. But the minimum between 0 and a negative number will be that negative number itself. Okay, so if a return is above 2%, it contributes no downside risk, so we mark it as 0. But if the return is below or 2%, like these, okay, sorry, like these, 1%, negative 2%, okay, so you can see how much deviation these returns are having from the target return of 2%. So 1% is below 2% by how much? By 1 unit in the negative direction. That's why we have negative 1 over here. Okay, so we carry out this deviation. We carry forward this deviation from the target. Okay, so this step is, you can say, the most important step, right? Only the downside deviations are included in the calculation. And of course, then you square them. Okay, and when you square them and add them, you will get a total of 26. Okay, now let's look at the formula. So this was the formula. Okay, 1 divided by n minus 1. Now this formula we presented earlier in a different manner. We actually wrote these words for all over here. Okay, now this for all is kind of being internalized in this min function only, or through this min function only, which we are writing over here. Okay, so this is the formula now. Okay, so if you see, we have got the sum, this part we have already obtained as 26. Okay, so we just divide it by n minus 1, n is 5, and then we take the square root. So we are going to get approximately 2.55 or 2.5495 to be precise. Okay, so this example highlights three main ideas. First idea, only returns below the target matter for downside deviation. Second idea, positive deviations are ignored. Okay, they are not offsetted against the losses. And of course, the third idea, that although this column is not mathematically necessary, it is kind of helping you to clearly connect the raw data to the downside risk logic. Okay, and see which ones are, what are the total deviations. Okay, and then in the next step, we are ignoring the positive deviations. Okay, So overall, you can say that downside deviation provides a more investor relevant measure of risk, especially when the concern is underperformance relative to a target. Okay, rather than the concern being total volatility. Okay, fine. Finally, we introduce the last measure for this chapter, coefficient of variation. So coefficient of variation, or CV, it expresses the standard deviation as a percentage of the mean. Okay, so basically the volatility is scaled by the level of expected return. Okay, and by doing that, CV allows us to compare risk, okay, across investments with different scales or units, something standard deviation alone cannot do. So this is the formula: standard deviation divided by mean. Okay, so for, of course, if you have a population, this will be written as sigma by mu. If you have a sample, then you will write as sigma, S divided by x bar, where S is the sample standard deviation over here, mu is the, sigma is the population standard deviation, mu is the population mean, and x bar is the sample mean. Okay, now because the numerator and denominator both, they are in the same units, CV itself, the coefficient of variation, is unitless. Okay, it does not have any unit. Now, when the coefficient of variation is low, okay, less than 1, it indicates less volatility per unit of mean return. So in other words, the investor is taking less risk relative to the expected return. And if you have a high coefficient of variation, okay, it indicates greater volatility per unit of mean return. It means that the investment carries more risk relative to what it is expected to earn. Okay. Now the key takeaway over here is that the coefficient of variation, it measures relative risk, not absolute risk. Okay, so that's why it's quite useful when you're comparing investments with different average returns. Okay, and it will in fact be more informative than standard deviation alone. Okay, so in terms of, say, the CFA exam, you can remember this, that if you have to compare investments, then coefficient of variation becomes a very important measure. Now, one more thing which I want to emphasize over here, and this is, I think, important from the exam point of view also, that the coefficient of variation can become misleading when the mean return is very small or negative. Okay, a very, you can say, a classic conceptual test point, which I think is extremely important, because when the mean return is negative, the coefficient of variation will actually lose its economic meaning. Okay, the mean will no longer represent a reward. So dividing volatility by a loss, it will produce a ratio that cannot be interpreted as risk per unit of return. And even comparability becomes meaningless, because if you see, let's say you still want to apply the consistent mathematical definition, there will be a problem when you're comparing negative numbers. Okay, you can get abrupt results. Okay, you can easily verify it by having some negative numbers as the mean. But from the CFA exam point of view, just remember that when you're comparing investments, CV is important, but CV does not make economic sense when the returns are negative. So let us see a very basic example. An analyst is comparing three sectors to see which one has the most risk relative to its return. She examines their average returns and volatility and uses the coefficient of variation to decide which sector is the riskiest. Okay, so this is the table. This table is listing the technology, consumer goods, and the energy sector. Okay, this will be, there will be bracket over here, CON. Okay, or maybe CONS. Uh, so along with their average monthly returns and also their standard deviations. Again, standard deviation is also measured on a monthly basis. So these values will allow the analyst to compute each sector's coefficient of variation. Okay, so that the analyst can determine which sector has the highest risk. And this is the question based on the CV, which sector exhibits the highest level of risk relative to its return. So it's a very simple calculation. It's a very, very simple. You just have to divide the standard deviation by the average monthly return for all the three cases and see which of the three sectors is having the highest coefficient of variation. So let's just do that. Very, very simple. So this is the formula as we saw. Let's say this was a sample. We are dealing with a sample. So for the first one, it is 1.9 over 2.80. Both are in percentage. So no problem at all. There is no unit involved. 0.6786 for the consumer sector. So this was actually CONS. Okay, and here and there's a bracket which is missing over here. Okay, no worries. So for the consumers food sector, consumer goods, it was right, consumer goods, I think. Yeah, for the consumer goods sector, it is 0.6875. Okay, just verify the calculations yourself. If there is a mistake, you can correct it later on. And then for the energy sector, you have 0.75. So obviously the correct answer is the energy sector. See, it is the riskiest sector relative to its return. Okay, so very basic calculations. Fine. So that's it. This is the end of the lecture. It was a lengthy lecture. So in this lecture, we have built the statistical foundation for some of the financial analysis aspects that we are going to discuss later on. So we started by classification of data. We distinguished between numerical and categorical data. We understood cross-sectional structure, time series, panel data structures. Then we learned how to organize and summarize data using frequency distributions, contingency tables we discussed. We also saw the visualization of data using charts, appropriate charts based on whatever objective you have, okay, analytically. And finally, we covered descriptive statistics. Okay, that was the third part of this chapter. Okay, organizing, visualizing, and describing data. So third part was descriptive statistics, where we focused on measures of central tendency. I think quantiles, dispersion, and then all the dispersion measures, including the CV1, which we studied last, and how each one of them is used to describe the location, the variability, and the risk in general. So this chapter is kind of foundational. Okay, and the tools which are learned here will be used in a number of places throughout the CFA curriculum. Okay, fine. Thank you for attending. All the best. Namaste.